IRAs and 401ks are both horrible, in my opinion. In this episode, I'm going to address the question, what is the difference between a 401k and an IRA? Now, that was a little bit harsh, but I have this little ditty in my life, good, better, best. Never let it rest till good gets better and better gets best. Now, IRAs and 401ks may have been a good way to go, but they have always been a far cry from the best way to go. So put your seatbelt on. I'm going to enlighten you on why I have never owned an IRA or 401k, never will. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist for more than 46 years, and I have never advised any of my clients. We have over 10,000 clients that we've assisted, and I've written 11 books, and I have never recommended that people prepare for retirement by putting too much money, or maybe not even any money, into traditional IRAs and 401ks. So let me explain to you why, because when people ask, so what's the difference between the two? Let's address that one first. You know, a 401k is usually a company-sponsored plan. It's where the employer will allow you to put in pre-tax dollars, okay? Maybe the employer matches 50 cents on the dollar or whatever, and so you may put in 4% of your income, they match another 2% or whatever. Now, that may be okay, but a lot of people don't realize the negative impact of taxes on the back end. But 401ks are generally through your employer. They are funded with pre-tax dollars. An IRA is usually an individual retirement account, is what it stands for. And so you own that individually. You actually put money in and you deduct off of your taxes what you contributed up to whatever the government allows. You actually deduct it off your taxes, whereas 401ks, you're putting in pre-tax dollars. You didn't earn it and then have to deduct it. It's not reported that you earned it and then you had to make a deduction. It was pre-tax, and you will pay tax when you take it out. But the same is true with an IRA. Now, they're both qualified plans. Qualified with who? The government, Uncle Sam. And he's your partner on those. So let me explain why I've never owned one and I never will. An IRA, 401k, 403b, 457, pension plans, profit sharing plans, these are all qualified plans. Qualified in the Internal Revenue Code to generally be funded with pre-tax dollars, or you can tax deduct what you put in there like an IRA. Now, we also have Roths, which I'll talk about here in just a moment. But when you have a qualified plan, there are strings attached. You can only put in a certain dollar amount per year or a certain percent of your income. Some advantages might be that your employer may match you. You get to fund it with before tax dollars, but then it accumulates tax deferred, not tax free, tax deferred. And then you agree to pay tax when you take the money out during retirement. And when they first were introduced, most people, most advisors did it under the premise, well, you're going to be in a lower tax bracket when you retire. So you want to defer, and it will grow to a bigger sum of money, and then you'll pay tax in a lower tax bracket when you retire. Well, folks, that was the premise, but that has not been axiomatic, automatically true for over 25 years. But it took the financial services industry to finally admit that was the wrong advice, because they're always talking about being a fiduciary. What's a fiduciary? Someone who looks out for your best interest. And if they admit that even though they knew you were headed for as higher tax bracket as you've ever been in retirement, because you're killing all your deductions along the way by paying off your house, and the kids are now gone, or if they're not gone, you can't deduct them anymore, and you're not contributing money to these IRAs and 401ks, and Congress keeps raising taxes and eliminating deductions, people are in as high or higher tax brackets when they retire as they were in when they were earning money. I've done these kinds of analysis for all kinds of professionals, school teachers, and they've always been flabbergasted when they found themselves paying back every dime they saved in tax. Over 30 years, 35, 40 years on the contributions. The seed money is what I call it, because if you were a farmer and you had the choice of, buying your seed in the springtime, and you didn't have to pay tax on what you paid for the seed. And you planted, you cultivated, you irrigated, and worked hard. And then in the fall, when you harvest your crops, now you agree to pay tax. See, that's a traditional IRA or 401k. People thought they were going to be in a lower bracket, and they weren't, because they were going down the highway with one foot on the gas pedal and the other foot on the brake pedal, and they didn't know they were doing it. They're deferring, and then killing the deductions. That's the foot on the brake, by paying off their house. And I'm not saying that's a bad idea, except you're killing your deduction. The kids are gone, and if you're a business owner, you don't have those deductions, and Congress keeps raising taxes. You're not contributing to these accounts after retirement. People find themselves in a higher bracket, and they pay back. The average school teacher that I ever analyzed paid back every dime they saved on the seed money, the contribution money, over 30 years. They paid that back in the first 2.5 years in retirement on the average. And every 2.5 years thereafter, they paid it back again and again and again, to where they were paying back 8 to 12 to as much as 15 times the taxes in retirement than they saved during the contribution years. Whose retirement were they planning? Theirs or Uncle Sam's? So what's better? If it's not clear, first of all, I think they're horrible because they're taxable. And I'm not the only one. Back in 2008, Stephen Gandel wrote the cover story for Time magazine. And it said, why the 401k should be retired. What you can do that's better instead. His opening sentence said something like, the 401k is a financial flop, a rotten repository for our retirement reserves. Now, he was talking about, because most Americans for the second time in the decade from 2000 to 2010 lost 40% on the average in their IRAs or 401ks because the money was in the market. And so during that decade, people, we call it the lost decade, they lost 40% from 2001 to 2003. Took 4 years to make it back, and in another one single year, 2008, they lost 40% again. It took till 2012 just to get back to break even. People following what I recommend tripled their money in that period, where most Americans who had their money in IRAs and 401ks in the market, if they had $1 million in the year 2000, they still only had barely over $1 million 12 years later in 2012. Whereas people following what I'm going to share next, they had $3 million for their $1 million. 3 times as much money. IRAs and 401ks, if they're in the market, that is not where you want your money in retirement. And you're postponing, you're delaying, you're procrastinating paying tax. When I ask people, how many of you think future taxes are going to be lower? Nobody raises their hands. Look at the deficit spending, the economic stimulus, the bailouts, and people wanting student loans forgiven and Medicare for all. This is going to cost us $100 trillion in the next 10 years. You divide $100 trillion by 10, that's $10 trillion a year. And the IRS only brings in $4.5 trillion in revenue total. Hello? Where's the money going to come from? The General Accountability Office, Congressional Budget Office estimates taxes will go to 50, 60, 70%. So if you think taxes are going to be higher in the future, which I do, why do you want to continue to postpone, delay, procrastinate, and accumulate this big nest egg, and then pull out your money down the road when we're all convinced taxes are going to be higher? That doesn't make sense. So when we talk about IRAs and 401ks, these are qualified plans. I would rather put my money in a non-qualified plan, meaning I don't have all these strings attached. And so that's why my favorite vehicle is a max-funded IUL. IUL stands for Indexed Universal Life Insurance Contract, but it's structured with the least amount of death benefit the IRS will let you get away with, and you put in the most premium, and it turns into a cash cow. This is where I have earned 7 to 10% tax-free, not tax-deferred, tax-free rates of return for 45 years. In fact, the last 25 years, I've averaged 10.07% net after all fees, cash on cash. Most advisors don't even know how to structure these, but this is by far my favorite vehicle. And I want to just share a test that you need to apply to money that you would consider putting into an IRA or 401k. Now, If your employer matches you, don't put in $1 more than you're being matched. If they match you 50 cents, I see so many people put in way more than their employer matches. I would not do that. And by the way, match, usually the employer is simply covering your tax. If you put in $1, they match you 50 cents, you got $1.50. You pull out $1.50 out of there and you got to pay the government a third of that. So your employer is covering the future tax liability if taxes were only 33%. So that's okay, but don't put 1 red cent, in my opinion, into an IRA or 401k more than what your employer is matching. If they're not matching, I wouldn't even own one. So let me show you what I think is better. So to be clear, I've never owned an IRA or 401k, never will, because in my opinion, they're horrible because you're not saving tax. You're actually bringing on Uncle Sam as your partner. And as a partner, he's saying, hey, in this partnership, I get, let's say, 33%. I get a third of everything that your business is going to grow to if you're starting a business together. You do all the work and everything. And if you want to sell before I'm ready, I'm going to penalize you 10% on top of the third. See, if you touch the money out of an IRA 401k before you're age 59 and a half, there's a 10% penalty. But if you don't start taking money out by age 72, it's a 50% penalty on top of the tax because the government wants all that out and taxed. So your partner on these, Uncle Sam, is saying, if you don't start taking money out and giving me my share by age 72 at the minimum amount I require, then the penalty is 50%. But if I feel like I'm more hard up, I can change my percentage from a third to 40 to 50 to 60%. I call the shots as far as my share. Would you go into a partnership in a business with someone like that? Well, I just described an IRA or 401k to you. So my preferred vehicle is totally tax-free. It doesn't have these strings attached. I can put in a large sum of money, $200,000 or $300,000 in a banner year. You can't do that into an IRA, 401k, or a Roth. If I don't have a good year, I don't have to put in anything. If I could put in $300,000 and I don't, I only put in $30,000. In future years, I can make up for the $270,000 that I could have put in that I didn't. You can't do that in an IRA or 401k or a Roth. I can use indexing and participate when the market does well, but never lose when the market goes down. In my account, if I die, it doubles or triples right now if I died at age 68 and transfers tax-free to my heirs. There's not an IRA or 401k or a Roth around that will do that. And so I can also access money before age 59 and a half with no IRS penalty. So why would I own an IRA or 401k or a Roth when I can have all those benefits and none of the strings attached? In January, a couple of years ago, the Wall Street Journal said the original champions of the 401k lament the day they ever came up with that idea. Why? Because it's not serving Americans well. They lose money in the market. You can't create predictable income, and they're not in a lower tax bracket when they retire. So think about it, and if you want to learn more about my favorite vehicle, let me show you how to get a copy free of my most recent best-selling book. So if this is intriguing you, I'm an author. I've written 11 books. My most recent book is a bestseller, The Laser Fund. They're flying off our warehouse shelves. It's actually 2 books in one. There's this one and this one. This one is 200 pages, 14 chapters with all kinds of charts and graphs. The Laser Fund is my favorite vehicle. It stands for Liquid Assets, Safely Earning Returns. That spells the acronym LASER. If you learn more from stories, you flip the book over, and this is 12 chapters, about 100 pages, with 62 actual client stories and examples of how the Laser Fund is used not only for retirement, but college funding, business, real estate management, all kinds of uses like emergency funds. So I'll tell you what, if you go to laserfund.com, I'll buy the book. I'll send it out to you. The book is free. You pay $5.95 shipping and handling. There's also options there if you would prefer to listen and learn with the audio or watch and learn with video courses. But I want to empower you. Please claim your free copy.